In fact, Sumeet Jain joining our senior research analyst at CLSA, looking at the IT sector very, very closely. And I was going through your report, Sumeet. Clearly, you've spent a lot of time asking and perhaps answering the biggest question in the sector right now. How definitive will be the Gen AI rollout on companies' profitability? Is there some time before we start seeing the benefits which everyone's talking about? And what have you found?
Yeah, thanks for having me on your session. And I think on the Gen AI, the jury is still out. I think the house is still divided as to how the impact will play out. But I think it will happen over the next 3 to 5 years or maybe even longer. I mean, we know that cloud has been in the market for the last 2 decades, and we have seen still 40 to 50% of workloads are on public cloud, and majority of the workloads are still on premise. So I guess Gen AI has a very complex technologies stack, and it will take time for companies to adopt. Now, Gen AI, if you evaluate, it's a combination of an LLM as well as an RPA. So LLM, obviously, as you know, is probabilistic in nature, and enterprises need accuracy every time they are working on a solution. So which is where I think the Gen AI will take time, and the house is divided as to whether the deflationary threat will be ahead of the volume opportunity or vice versa. So I guess every 6 months, we host this virtual or physical Gen AI tours, and we get more information on ground from the company CTOs as well as startups. So very interesting times, clearly.
Interesting. How you see Indian companies faring, and TCS is not necessarily at the top of that pecking order in the context specifically of Gen AI rollout, isn't it?
So see, I mean, in terms of capabilities, we find TCS to be extremely good, because you have to realize that the Gen AI technology, when it is being rolled out, there are a lot of grounds of work which need to be done. And that grounds of work is actually around data analytics and engineering. So, as per various consultants like McKinsey, BCG, 70 to 80% of the work in any Gen AI deal is around data analytics. So you need to have a structured format of data in a proper lakehouse or a warehouse. Similarly, a lot of your data should be either on cloud, or let's say if it is on premise, you need to secure NVIDIA GPUs to upgrade your on-prem infrastructure. And similarly, you need strong cybersecurity tools. You need to integrate SaaS solutions which are infused with Gen AI, where if you look at Salesforce, SAP, they have all come up with their agent forces. And then, of course, you need a very strong RPA automation practice. So we have identified these 5 areas, which are the backbone of developing Gen AI solutions. I think typically we have seen TCS as a company which rolls out these solutions pretty fast once the technology is mature and scaled up, so that it doesn't hit their profitability. But we believe, over the next few quarters or years, you will see that event playing out, and that's where the opportunity will roll up in the hands of TCS. So we are quite positive on that name as well.
Sumit, good morning, Neeraj here. So with the TCS, and we'll get to the pecking order too, but do you believe that based on the recent conversations that you may have had with the IT companies, either at a conference of yours or in meetings that you might be doing, that the commentary this time from the companies would become very important? Is it possible to envisage that the IT companies will say something that will give a great idea of what the rest of the year could have in store?
So Neeraj, I think great question, and I believe a lot of pent-up demand is out there as far as digital transformation is concerned, particularly beyond BFSI vertical. And that's where, if you remember last year when there was this talk that the US Fed will start cutting down interest rates over the next 1 year, but that probably did not pan out because of sticky inflation and then the tariff-related uncertainty. But now, I think that question will be again on top of mind for every investor, and let's see if companies give any clarity as to what kind of interest rates or inflation and the Fed action will lead to discretionary demand revival over the coming quarters beyond BFSI. And there is always this trend that BFSI is one of the first vertical to see discretionary demand revival, and then other verticals follow the suit with certain quarter lag. So it's been more than 4 quarters now And we believe that over the next 2 to 4 quarters, that discretionary demand revival beyond BFSI should start to happen. So having said that, I don't see a material change in the commentary of the company managements compared to, a month back. But still, I think the overall macro news has been stable since April when the guidances were issued by, let's say, Infosys, HCL, and Wipro.
Got it. And Sumit, the other thing would be the valuations at which the companies trade at. Now, one is what the companies do in terms of earnings. Two is what you, for example, are comfortable assigning a valuation at. Is the new normal higher than the averages of the last 5 years or the last 10 years, as the case may be? Or do you believe there could be a derating if indeed the companies fail to deliver for another couple of quarters?
Yeah, Neeraj, I think that's a great question and the most debatable point among the investor community. And there, we believe that if you look at the growth in BFSI vertical in the last 1 year, it has given a 2.5% CQGR kind of a growth. So, if the overall potential for IT services is more like low to mid single digit growth overall, that is what we have seen for the last 3 years, then BFSI vertical itself should not have grown at 2.5% CQGR. So, we believe that that growth for the sector should more be like mid to high single digits. That has been the last 8 to 9 year CAGR for this sector, because I think obviously we had a sharp V-shaped COVID recovery in 21 and 22, and then a sharp deceleration over the last 3 years. But you look at the last 7, 8 year CAGR, it is around 7 to 8%. So that's what we believe the sector growth should revive back next year when the Fed cuts down their interest rates by 2 to 3 times, or let's say the overall macro in US is better and we see discretionary demand revival beyond BFSI.
Okay, so all things considered, TCS remains most constructive. How do you look at some of the other majors? And do you think that there's further upside, Sumit, maybe in the mid-tier IT companies?
Yeah, so see, I can't comment too much about stock specific what we are expecting, but we generally are quite positive on the overall space. I mean, like Infosys, we are expecting a sequential growth this quarter because of the seasonality. Plus, the overall order booking by all Indian IT companies has been better than what it was in March quarter. So maybe, that could be a trend that in June quarter, Indian IT companies were more aggressive than Accenture, where if you remember, Accenture reported a weak order booking number also because of unfavorable base. So we like the overall sector given the fact that we're expecting a V-shaped recovery in the coming quarters as well as in FY27. And the valuations part, which Neeraj also talked about, it is attractive if you compare on a last 5 year average basis, maybe not on a 10 year basis. So overall, we like the sector. And of course, I mean, Infosys, Tech Mahindra, Persistent, these are some things we are more positive upon the near term.
Okay. Just let me not get stock specific then, but Sumit, I think the bit of the, I won't say confusion, but the mixed view on Indian IT is in context of what's happening with the American economy, what's happening with tariffs, what's happening with American government spending and the business outlook there. What side of the fence are you on right now? Because the street doesn't seem to be able to make up its mind on whether this quarter is going to be decent for Indian IT or not.
Yeah, no, I think, obviously we are too fixated upon the near-term quarterly commentary by the company managements and maybe ignore the big picture out there. But if you look at the US economy, it is still quite resilient. Despite the talk about inflation picking up quite materially because of tariffs, we haven't seen that actually happening as far as the data is concerned. The overall job prospects have been pretty decent in US. Of course, I mean, some of the tariff-related impact is being absorbed by the companies in US in terms of lower margins. But still, the overall economy looks pretty good. And then, if you look at CY26 in US over CY25, you will have midterm elections then, and the economy will be growing off a favorable base of CY25, where particularly retail and manufacturing sectors will have a weak growth this year because of tariff uncertainty, which I think should go away next year. So, which is where we believe, if you look at the overall macro context, the interest rate cuts in US, the overall maybe reduced fiscal deficit because of tariff-related revenues coming in for US economy, and then of course a favorable base to grow upon with midterm elections. So I think if you combine these 3-4 factors and plus last 3 years of subdued growth for the IT services sector, where a lot of pent-up demand is out there as far as digital transformation projects are concerned, we see the setup being quite positive for the next financial year and maybe next couple of quarters itself.
Sumeet, because now I'm just divvying up between large caps and non-nifty names, right? And because the large caps or the larger businesses have this traditional business as well, which probably will scale down as a result of AI or otherwise. But is there a case that some of the smaller businesses which have the ability to be more agile and more nimble still continue to show decent growth, and therefore the street's still rewarding them? I mean, I'm not asking you to say names, but just so that the viewers understand, the valuation multiples for the Persistence, the Coforges, etc., is very, very high, right? And maybe with reason. Do you reckon that continues?
Yeah, no, Iraj, I definitely believe that, Gen AI is creating a level playing field across IT service firms. So actually the size really does not matter, although the larger size firms will have to cannibalize their legacy services to some extent. Now it all depends on how willing they are to do it. But we had experts on our Gen AI session, the Gen AI Access Day, a couple of weeks back, where most of those experts are of the view that the speed of acting out here in Gen AI is extremely critical. And even the large caps who are executing well can grow strongly in the Gen AI space. So it all depends on how quickly you are acting, how quickly you are willing to cannibalize your legacy business. Because this is a new field which is emerging called services as a software. And that, as per few consultants, could be a $1.5 trillion market in the next decade, taking away share from both IT services as well as the SaaS market. So both IT service firms and the SaaS companies going forward can have a very similar kind of business model where you have AI agents being rolled out, and the pricing model will be either outcome based or it will be consumption based in terms of usage of cloud or tokens going forward.
Okay. So with quick 30 seconds, we're out of time completely, but are you negative ER&D companies, especially auto ER&D? Quick 30 seconds, please.
So, I mean, we don't officially cover it, but yeah, I mean, valuations are always, tricky in that space. So, but yeah, I would refrain to comment since we don't cover it.
Fair call. Sumit, leave it at that. But thank you so much. Really appreciate you taking the time out and being with us. And maybe we should do a review conversation once the quarter is out, Sumit, to just get a sense of how it lived up to your billing.
Surely, look forward to it.
All right, cheers. Thank you for that. So that's the view on information technology. Now,